Ladies and gentlemen, I brought the whole setup today to my restaurant because I already knew it was going to be a rough day tomorrow and futures were going to look nasty. And, well, that's what happened. The NASDAQ is currently down 2.31%. The S&P is down about 1.8%, and the Dow is down 1.28% here in essentially pre-market trading. 10-year Treasury yield futures are break even on the day. It will be interesting to see what happens in Treasury markets. Because stocks have been so correlated to Treasuries, at least more of your risk on areas of our markets. Do people actually buy treasuries as a flight to safety? Are they more concerned about economic growth slowing down? Or are they more concerned about inflation? Now, just so we're all on the same page, treasury yields are opposite to what people are actually doing, right? So if more people go out and buy the bonds, 10-year treasury yields actually fall. They will be red. Okay, if people go out and sell the bonds, they're not buying the bonds, then 10-year treasury yields will be green or higher on the day. I think that'll be very important to pay attention to tomorrow. And if you are a viewer of this channel, I will keep you updated in what's going on in bond land, because the bond market's 5 times larger than the stock market roughly. It is massive. So bond investors, they can give you a little bit of a heads up just how bad things are, or how, well, maybe we shouldn't be as worried. Now, oil futures are up over 2% to $74.04 per barrel. Now, some of the big news that I really want to share with you guys, some of the latest developments here. This is coming out 12 minutes ago. U.S. President Donald Trump says he will be cutting off all future funding to South Africa until the investigations of treating certain classes of people very badly is completed. And if you don't know what has been going on in South Africa, like the government's been seizing property, like not paying people for it. There's been a lot of not great practices happening in that country. People are saying, hey, is that the next country we are going to enter a trade war with? Potentially. Now, the Mexican president says the U.S. has a grave problem with fentanyl addictions, and she goes on to say that tariffs ordered by U.S. on all Mexican goods will hit United States with higher prices. Okay, that's the whole inflation argument, and I think that sounds sexy on paper, that you raise costs for businesses, they pass that cost on to consumers, but in fact, it's not the reality of the situation. Consumers, I don't know, who you know or who you talk to, but when price goes up, people buy less, okay? And they start to revolt, and they start to trade down to less expensive options. So the less expensive options are going to win in this new tariff environment. But if you're a company, I used this analogy in the last video, if you're a toilet paper company and you make a high-end toilet paper that's more expensive than the one-ply stuff, the bad stuff, okay, you're not going to be able to raise prices and continue to sell as many packages of toilet paper as you did previously. People will start to change to different alternatives. So perhaps you could pass on a little bit of that price increase, but you will have to offset that by laying people off internally at your business, by becoming more efficient. This could actually be bullish for AI. Not the most bullish bull case, right? But if AI could help businesses be more efficient, I mean, this is really positive for like Optimus and humanoid robots and things of that nature. Because if you could start putting just robots in there, start lowering cost internally at companies, that essentially gets around the whole 10% tariff issue. So if you're not able to pass that cost on to consumers, what do? You get more profitable internally. You lay people off. This could be bad for the economy and ultimately bad for the labor market, which in fact could force the Fed to cut rates aggressively in the next couple of months. Again, President Scheinbaum says that 25% U.S. tariffs will have a grave impact on both U.S. and Mexico's economies. I already knew today was going to be really bad when Bloomberg reported today that Trump's tariffs cover nearly half of all U.S. imports. quote, will create a material supply shock and eats into growth and is inflationary. When combined with this widespread ICE efforts to curtail migrant workforce, compounding impact on housing jobs and consumption lands recession within 3 months, but labeled as such in Q3 due to definitions. So they're saying we're going to be in a recession by essentially September of this year. Whenever you have Bloomberg that starts to come out and say we're going into a recession, that essentially it's already a conclusion, yeah, you're going to have a negative reaction in the stock market. Like, stocks are not going to like that at all. Okay, now sure, that's going to mean aggressive cuts by the Fed, and hopefully that helps to offset some of that. Now, do I think we're going into a recession? No. I think Trump would back down at that point. If we go into a recession, the S&P is going to fall well over 20%. At least 20%, you would imagine, probably more than that. And the trade war is going to be canceled. But the trade war is not going to be canceled until we fall a lot. Last time around in 2018, the S&P had to fall 20% before Trump and President Xi at the time, China's president, backed down on the trade war. And I've talked about that in previous videos. It's not a good situation to be in, right? That's not ideal. And that was this right here. It was a 20% fall in the S&P. We have already heard of tariffs being put on the U.S. from Canada, which is around $130 billion worth, which is a lot of our trade with Canada. So it's almost like a 25% tariff Canada put back on the U.S. for retaliation. But the next step of this will be Mexico. And Mexico's President Claudia Sheinbaum ordered retaliation tariffs in response to the U.S.'s decision to impose 25% tariffs on all goods coming from Mexico. But there were not specific details on what Mexico's tariffs are going to look like. So it looks like a full-blown trade war at this point. Futures, again, NASDAQ futures down over 2%. S&P's down 1.5%, and the Dow down over 1%. It was also reported today that Ontario is going to just completely remove U.S. alcohol from shelves after Trump's tariff announcement. So, again, are we doomed? Are we destined for a crash here? I wouldn't say so. I wouldn't draw those conclusions yet. But I think a lot of people on Wall Street, even Goldman Sachs, came out today and they said they think the tariffs are going to be temporary. I don't think so. I think this is the foundation. And if, there's other things that Trump disagrees with, he can throw around the idea of a 50% tariff or 100% tariff, right? I think this is... This could be the end of the tariffs, or it could just be the start. I don't think they're going to be walked back on. It's possible, but that's just not what I see from this situation. So with markets sitting near all-time highs still, we may not be priced for a trade war, which you can almost say with certainty we're not priced for a trade war. And then again, we're kind of going to be divided here, where some people think tariffs are going to be inflationary. Other people like me think tariffs could actually be a drag on the labor market, could be a drag on the economy more than it's actually inflationary. See, normally you don't have a weakening economy and inflation issues, right? Normally when you have a weakening economy, as Bloomberg is reporting, could be in a recession in the next 3 months, that's usually a very disinflationary kind of environment. It's pretty damn rare that you ever have some kind of recession or low growth environment with high inflation or rising inflation. And again, back to the basics of inflation. Inflation is when the money supply increases. And it's not increasing as of now. So should we be concerned about higher inflation? I don't think so. But I think, again, the one area that investors are not going to look at is the labor market, is the economy. That is the area that would, I think, really take the hit from tariffs. Yes, that could cause the Fed to cut rates sooner rather than later. Probably by March is all but guaranteed at this point, in my opinion. But it's going to take a little while for the markets to realize this is not bad for inflation. This is bad for the economy. And ultimately, when you enter into a slower growth period, when you enter into what, again, Bloomberg says is going to be a recession in 3 months, I don't think it's going to be that dramatic. But when you enter into an economy like that and the economy is slowing down, that's not a good thing for stocks. That's not an environment where stocks do well. Think about the last couple of years. Stocks have done well, even in spite of higher inflation and sticky inflation, because the economy has continued to do well and earnings have continued to rise. What happens if the economy weakens and earnings do not continue to rise? Then to some extent, it doesn't matter what happens, with inflation. Right? Obviously, inflation coming down is good overall, but if the economy is weakening and we're heading into recession, that's not good at all. Okay, so whether you care about inflation or economic activity, both of those things lead down the same path, and that is weakness in the broader markets. Now, for the headline S&P, really level I would be watching for is the 50-day moving average at about 596. It looks like we're going to open below that. We're probably going to open around the 590-ish level if I were to imagine coming tomorrow. You really want to watch to see if we find support around 584. If we don't, that's where things get nasty. Now, for economic data coming out tomorrow morning, you will be getting the S&P Global Manufacturing PMIs, final numbers for January, and then ISM Manufacturing PMIs for January. You're actually expecting things are going to get a little bit better from last month, where you at 49.3. We're expecting a number of about 49.8. Employment is expected to get better, quite modestly. Construction spending is supposed to get a little bit better. Last month it was at 0%, expected to rise at 0.1%. ISM manufacturing new orders is expected to stay roughly the same, and prices paid is expected to stay roughly the same as well. You also get a speech from Fed Bostic, considering we just got tariffs put on by Canada. We just put tariffs on Canada, Mexico, and China. It will be interesting to see what Fed Bostic has to say about that. If this opens a door for the Fed to be more dovish, to be worried about the economy, or if the Fed's going to take the typical, economic approach right now and say that tariffs could be inflationary and really go on the hawkish side. Now, we're also going to get a speech from Fed Musaliam at 6:30 p.m., and that Fed Bostic speech is at 12:30 p.m. So we do have some catalysts coming out tomorrow. On Tuesday, JOLTS job openings. On Wednesday, you have the ADP employment change. You do have exports, imports, ISM services, PMIs. On Thursday, you are going to get your, speech from Fed Waller. I believe you get Fed Daily, a couple other Fed speakers that are going to speak here, Challenger job cuts, initial jobless claims, and then on Friday you get your big data with non-farm payrolls as well as the unemployment rate. Now, as well as that, we do have some earnings. Okay, Monday, Palantir is going to be your big name. Tuesday, pre-market, PayPal, Spotify, Pfizer, Regeneron, Pepsi, Merck, Estee Lauder. Tuesday and after hours, AMD, Alphabet, Snap, Chipotle, Enphase, Amgen, EA. Wednesday pre-market, Uber, Walt Disney, Novo Nordisk, Toyota, Boston Scientific, and others. Wednesday and after hours, Ford, Qualcomm, ARM, Symbotic, O'Reilly Auto Parts. Thursday, Eli Lilly, Roblox, ConocoPhillips, Peloton, Hershey, Bristol Myers, Tapestry, Yum, and Philip Morris. Thursday and after hours, Amazon, Elf, Cloudflare, Affirm, Fortinet, Microchip, Pinterest, MPS, and Powell. And then Friday, you have Canopy Growth and some other names. So another big topic now that will be discussed on these conference calls is who's tariffed, what are they going to do about it? And I think that's when Wall Street's going to realize if companies just start firing people then to make up the difference essentially in the tax. Like if you're now tariffed at 25% and you can lay off some of your workers and reduce that burden, I think that's what companies are going to do versus passing all of that cost on to consumers. I think they could probably get away with like passing on 2 to 4% of the 25% tariff. Like you could probably get away with that. Nobody would notice too much. It wouldn't be felt. Even in the inflation data, it wouldn't look like much change. But you're not going to be able to pass on 25%. No way in hell. So I think that's going to be a real critical moment for Wall Street. When companies start to say that they're going to look to fire people, they're going to put it more eloquently, of course, and they're going to look to reduce expenses internally in the business to pay for these tariffs. Well, yeah, that's when you're going to get more fears of the economy slowing down, and that's when the Fed may be forced to take a more dovish kind of stance here. And that's where the S&P could soon be falling to that 558 level, which would be down to this 200-day moving average from here, which would be a fall from current levels of about 7%. And once we get down to those levels, I think that's a great buying opportunity, number one. And I think that's when you really start to get Trump that questions, should he be trying to enact this aggressive tariff policy, or is it time to calm down on that? And, hopefully he does not want to crush the bull market. I don't think that's what he wants his legacy to look like. But he didn't waver until the S&P was down 20% in 2018. If the S&P were to fall 20% from current levels, you're going to be looking at a disaster scenario for equities, right? You're going to be looking at the SPY down to 481. Like, that's going to take you back to levels you have not seen since February of 2024. It doesn't sound terrible in the grand scope of time, but that would be a huge problem at this point. And, it's always hard to predict what the markets are going to do, but I think on a risk-reward basis, following the tariffs that actually went into effect and the retaliation that we're hearing about, you're more vulnerable for downside versus obviously upside at this point. So let me know what you guys think about this information down below in the comments section. Ladies and gentlemen, have a fantastic rest of your day. Now, I will say 10-year treasury yields are actually now down about 3 basis points. It looks like investors may be buying the bonds as kind of a rush to safety or flight to safety. If that is what you see, then it could be fair to say tomorrow investors are actually more worried about economic growth. And if economic growth does slow down, well, we've seen that has been a positive for markets before. We get a bad jobs report, that's good for markets, right? This whole, bad news is good news is bad news situation. Looks like face value right now, investors are saying, hey, we're not worried about inflation here with these tariffs. We are worried about the economy. Again, ultimately, that is downside pressure for markets as well, but I think it's better than just having another big spike in inflation, or at least that's the perception, right? So again, let me know what you guys think about this information down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.